We are providing a completely uncorrelated and sustainable opportunity of getting yields from real world activities. We do a very data-driven risk management. The business model of Helicap has been to provide sustainable wholesale capital on the balance sheet of non-bank financial institutions. We get a good diversification on the entire loan book that they are financing in emerging economies. The objective of Helix is to tokenize these real-world private credit opportunities that we have built expertise on and bring them on-chain to a Web3 native audience. We are looking at a differentiated source of liquidity in the form of stablecoins.
You have just heard from Jitendra Singh Jaitawat, partner and founding CTO at Helicap, as well as co-founder and CEO at Helix, an institutional real-world assets protocol connecting on-chain investors to real-world private credit opportunities. It is the answer to the issues plaguing DeFi yields in the TradFi credit financing gap. So let us dive right in.
Good evening from Tokyo. I'm very excited to be here with Jitendra today, who's dialing in from Singapore. Good evening, Jitendra.
Very good evening, Norbert.
We've met at so many conferences since the beginning of the year, and I've seen you on so many panels regarding real-world assets, etc. And I always thought there's so much more to this story. Maybe I can convince you to do a session with me. And here we are. Thank you for taking the time.
Thanks for inviting. It's actually amazing how we met in a conference. So really looking forward to the conversation.
And we, in theory, know so many people in common, but we haven't met previously. So you have a very interesting career that went from the public markets to the private markets, in particular private credit, and now into DeFi. Let's try to slice it up a bit and maybe take the first step when you went from public markets to private markets, once from a career perspective. What triggered the move, and then how did you adjust to a different market, or how different is it actually from a trading technology perspective to operate in the public market versus private markets?
I think the move from my previous stint at Goldman Sachs, where I was mostly focused on asset management and public capital market side of things, wasn't really something of particular inspiration to private credit as such, but it was more of a part of me had this itch that I really want to build technology from ground up. And finance being my domain, I was looking at FinTech as a potential avenue to start building some tech. At the same time, in Southeast Asia, I was seeing a huge growth in FinTech overall. During that time, I got in touch with my co-founders at Helicap, and I got to know they're building something in private credit. Their approach was, we want to build something data-driven. There I saw some real synergy in terms of how do we leverage data to bring institutional grade risk management in an asset class, which was at that point quite a black box. That's how I started in 2019. Now, in terms of timing, it's always pretty interesting for me. I started in public capital markets in 2008, just a week after Bear Stearns happened and 6 months before Lehman Brothers. Started private credit 2019, and then 6 months later, COVID happened. Started Helix, which is this real world tokenization in DeFi, right in the middle of DeFi bear market. Quite used to building things while times are difficult.
People say the bear markets are the time to build, right? So the
Absolutely.
timing was pretty good in that respect. And still, even if we're out of the pandemic, private credit still seems to be very hot. You're not the only player in Singapore, and there's white papers coming out of all consultancies and all of the investment banks on that topic. Is that buzz, or is there real investor demand behind it?
If you look at private credit as an asset class, before 2008, private credit as a distinct asset class didn't really exist that significantly. And since 2008, we have seen remarkable growth in this particular asset class. If you look at the data, it has reached $1.7 or $1.5 trillion as of end of 2023, poised to grow to around $2.5 trillion by 2027. That kind of speaks to the growth that has happened. There are a couple of factors that really triggered that growth. One was after the great financial crisis in 2008, there were regulation changes, and that led to stricter capital requirements on traditional banks. And that led to reduced activity in terms of traditional bank lending. That gave an opportunity for private credit players to come and fill in that gap, combined with a very almost zero interest rate environment. That has led to a significant growth. We see large volumes of institutional capital coming into the space, be pension funds, insurance companies, institutional asset managers, even banks are now coming back to private credit. It is definitely poised to grow continuously in the coming years.
The proof is in the pudding for all financial products. Always when you need to go once at least through a full cycle. You started this in 2019. We had the pandemic, we have zero interest rates, people looking for yield. So credit was super hot. And now for the last 18, 24 months coming out of that, we have a normalization of the interest rates, at least in the US and in Europe. And we've done away with the zero in Japan, but the rates are still near zero. It almost qualifies for full cycle. And so how has the market behavior changed, or has it?
Yeah, most of the private credit players, they would typically have floating rates. And so when the Fed rates increase or interbank rates increase, those portfolios also had their rates adjusted. But seeing that near zero interest rate environment to now where the Fed rates are like 4 to 5% kind of range, those private credit players who either had floating rate part of their structuring or the ones who had shorter tenured private credit loans, those were the players that still continue to get benefited.
For those that were able to borrow at US zero rates plus whatever spread for the credit, let's say 5 to 6%, that would be 9 to 10% or even more. Did it work? Were there defaults? How did the overall portfolio perform, and maybe also what adjustments were required for the models?
In our case, our loans are typically very short tenor, like 6 to 9 months, and then we roll over. We don't lock our capital for 12 to 18 months or 3 or 4 years tenors. We do a very data-driven risk management. The business model of Helicap has been to provide sustainable wholesale capital on the balance sheet of non-bank financial institutions. We get a good diversification on the entire loan book that they are financing in emerging economies. What we are financing is loan book asset, and hence we want to do a very detailed risk management and due diligence on that loan book financing. We tend to capture the loan data and then run it through our proprietary credit engine, which we heavily invested for the last 4 or 5 years to understand the health of the underlying loan portfolio, as well as the demographics of where the distribution of the loan portfolio is. We tend to look at stress signals in the portfolio, if any, and then that kind of helps us identifying risk as well as seeing if there are any covenants which are being breached. So it's a combination of how good the structuring is, what kind of governance has been put in place, what kind of tenors, pricing, all of those come into picture. And then all of that supported by a very data-driven credit risk assessment of the portfolio. That has helped us a lot to weather through, we went through COVID-19, where many jurisdictions had these repayment moratoriums. And there were times where we had to make certain decisions based on the stress signals that we saw from our credit analytics, which may or may not be visible in general if you're just looking at beautiful PDF reports every quarter.
How often do you get the data? How often do you look at the data points? Because in order to determine a trend, as you suggested, to determine a trend, you need to see this in some regularity and not in quarterly reports.
In our case, if we are working with digitally native FinTech kind of non-bank financial institutions, we tend to directly integrate with their loan management systems and capture the loan data almost on a daily basis, completely automated between systems. In case of traditional lenders, and there are many good traditional lenders in Southeast Asian region which have a significant history, and if we want to work with them, in those cases, we would have a certain frequency, at pre-agreed frequency, either weekly or at least on a monthly basis, where we would capture their loan tape and do the exact same kind of analysis on that data.
You said on the Helicap side, you're primarily focused on NBFCs. It's then these non-banking financial institutions that make a loan decision, let's say, vis-a-vis an e-commerce retailer. There's other players who might do that directly with the retailer, and so you need to get all the retail data and the sales from the e-commerce system. Are you doing it still at this very detailed level, or is it a bit more aggregated as to what you get from the NBFCs?
There are two levels of credit risk assessment happening here. When NBFI is disbursing the loan, they need to have some sort of credit decision at the point of disbursing that loan. In case of digitally native FinTech lenders, they will try to use alternative data points, sometimes telco data, sometimes social media presence, sometimes a combination of how you are filling the application. But all of those data points goes into typically sort of predictive model that gives them some sort of probability of default on that application. And so that's one level of a predictive decision that is happening at each loan originator, FinTech lender, or NBFI. When it comes to us, where we are trying to provide capital on the balance sheet of this non-bank financial institution, for us, the more important thing becomes the overall loan portfolio. the demographics of it, the vintage of this loan portfolio, how each monthly cohort of loans that they have disbursed since their inception has performed, what has been the repayment behavior of their underlying borrowers, how that repayment behavior has evolved, what their forward-looking non-performing loan rates could be. And all of those data points are being captured, including also a lot of yield cohort analysis. For example, at what point or how many months does it take for a particular cohort to break even to the cost of capital, for example. So the level of credit assessment on our end is at an aggregated portfolio level, and the credit assessment at the loan originator is on individual loan.
Especially in the Southeast Asia space, at the NBFI versus then ultimately the borrower, what loan size are we typically talk about on average?
It depends on which segment, and we cater to Helicap as a group, cater to a multitude of different segments, including microfinancing, multi-financing, leasing, education loans, agricultural loans, buy now, pay later, on-wage advance. So a whole spectrum of different lending segments. And the reason for that is that gives us a good diversity in terms of defining different lending segments. Typical loan size of the individual and loans would really depend on the segment, and also whether it is consumer financing versus SME financing versus embedded financing. It really would vary from sector to sector and business to business.
It's really very broad, whatever fits into the model, or where you can adjust the model that you can handle confidently the credit risk you be willing on the risk at a price.
And when it comes to institutional wholesale capital providers like Helicap, that would be typically a larger ticket size because there's a lot of due diligences involved. It's very institutional play because it is not happening direct to the end borrowers. It is at the balance sheet of the non-bank financial institution. It is structured in a very institutional manner in that sense.
You started with the origins after the global financial crisis and the banks withdrawing from it because it becomes too costly from a capital perspective. But then also the market we're dealing with is Southeast Asia, certainly a lot of places that are not fully banked. Some are even unbanked, some are underbanked. And these non-bank financial institutions fill the funding gap that is there. And I think you said on your website, the mission statement is to fill this $500 billion funding gap.
Maybe for the benefit of audience, non-bank financial institutions business is really to originate loan, which is a very similar business like banks. The only difference is banks can take deposits from people like you and me, whereas non-bank financial institutions cannot take deposits. So they will always have a dependency on some other institutional lender or private credit funds or some other private credit player to provide them the capital so that they can generate the end loans. Like in any other emerging economies, Southeast Asia is a broad spectrum. On one end, you have countries like Singapore, which is quite developed. They have very mature financial systems. And on the other hand, you have also a lot of developing economies, which would fit into a typical pattern that we see in emerging economies. The gap of financing was always there. Banks didn't have infrastructure all the way to the rural, remote areas. And that's the gap that NBFI started filling in, particularly in the past decade because of the growth of internet and penetration of mobile. Suddenly, many of these fintech services could be delivered all the way to the last mile. Fintech companies could have alternative data points on which they could do some sort of credit decisioning, which traditional banks may or may not have. That led to a significant growth in this region when it comes to private credit. And obviously, as you rightly mentioned, there is a significant portion of population which is underbanked or unbanked, close to 40+%, which is in that category, and adult population. Unbanked means you don't even have bank account, which is unthinkable in a developed economy. And underbanked is where you have a bank account, but you don't have access to credit. That leaves a huge financial gap, which many of these NBFIs are trying to fit.
We talked a bit about the borrowers, and that was a wide range, but who's providing the capital from an investor perspective? What type of investors? And also regional would be interesting if you can talk about that a bit. Where do you ultimately source the capital from?
Private credit as an asset class is at this point not that accessible to the retail investors. It falls in the similar segment as private equity, for example. Most of the jurisdictions would have some level of restrictions in terms of who can participate, and typically accredited investors have access to this asset class. Investors would be typically family offices, high net worth individuals, or institutional asset managers, pension funds, impact investment funds, etc., who would come in and syndicate these facilities either through a syndicated loan facility or deployment through a private credit fund, which then eventually get deployed into the sector. And we see a lot of interest, particularly from Japanese institutional investors, in private credit across emerging economies, but particularly in Southeast Asia. We see also a lot of Japanese financial institutions coming out and building significant private credit businesses. Credit Saison being one example, a very successful large financial institution from Japan. They have built their presence in Southeast Asia, LATAM, India, and building a significant private credit portfolio, which is a testament to the institutional grade interest in this particular asset class and subject.
Just last week, I spoke to some friends at MUFG, and for them, the highlight story is, of course, Mass Capital, the mass growth funds that they've created. And we have this mismatch, right? We have the huge balance sheets that are underutilized in Japan to a certain extent, and the opportunity to lend is somewhere else. Everybody is trying to think about ways to bridge that gap and make that balance sheet work a little harder.
Absolutely. Absolutely.
Now we're moving from private credit to real world assets, and we're tokenizing them. What are real world assets, and why is tokenization a good idea?
Tokenization as a term refers to representing an asset in a tokenized form on blockchain, be it money, be it some asset, could be gold, could be real estate, could be a private credit deal. And so the idea is that you fractionalize it, you tokenize it so that you can blockchain infrastructure in terms of potentially creating secondary markets, enhancing liquidity opportunities, as well as getting efficiencies in terms of the transparency and other aspects of blockchain. If you look at past 2-3 years of how the crypto and DeFi space has evolved, there was a significant bear market after 2021. And parallelly, there was another trend that was coming up, which was tokenizing fiat and growth of stablecoins. So past 2-3 years, that stablecoin market cap has grown to more than $150 billion and constantly growing. That really created a foundation for the stable coins are supposed to be pegged 1-to-1 to a US dollar or a particular currency. Once the stable coins came into place, that became a catalyst like, oh, now because we have a coin which is devoid of the fluctuations and volatility of crypto markets, could now the real world assets being brought on chain, and stable coins could build that foundation of marking the pricing and other aspects of it. That led to, for the past couple of years, this growth in RWA or real world assets as a trend. There is right now about $10 to $11 billion worth of real world assets that have been tokenized. That includes T-bills, that includes private credit, gold, real estate, other kind of commodities, including carbon credit and renewable energy, etc. There are entrepreneurs and in different pockets of the world who are trying specific asset classes and bringing them on chain. That trend is continuously growing, and the estimates are by 2030 or so, there could be 16 trillion worth of real world assets that could be tokenized. Now, in what form and shape, it really depends on how the blockchain infrastructure evolves and scale. But there is a significant interest. We can see BlackRock coming in, Franklin Templeton coming in, Goldman Sachs recently announced 3 different tokenized products, even though it was triggered by entrepreneurs, but now there's a huge institutional interest. When most of the traditional bank they started, it was always with private blockchain, but now the institutions are becoming more and more comfortable, at least to some extent, to try and tinker with public blockchains and deploy certain specific products on public blockchains. And I think that that's a trend that may continue to grow.
When you talk about Helix now, is it its own protocol? What blockchain you're running on, or which different blockchains are you supporting? And is that transparent to the investor? Do they care, or are they just looking at the financial product, and is it worthwhile investment?
The objective of Helix is to tokenize these real world private credit opportunities that we have built expertise on and bring them on chain to a Web3 native audience. We are looking at a differentiated source of liquidity in the form of stable coins. What we do here is for on-chain investors, we are providing a completely uncorrelated and sustainable opportunity of getting yields from real world activities. For real world businesses, we are providing access to a differentiated pool of capital in the form of stable coins. At this stage, the target audience in terms of investors would be Web3 institutions and Web3 family offices or digital asset managers, high net worth individuals to deploy capital. Once the financial markets are really on-chain rails, that may be a point where maybe it becomes agnostic where you are, the transaction always happen on blockchain. Now, in terms of where we have deployed, we are on public chains. We started with Ethereum. We deployed early this year on Ethereum and have built some TVL there. We have also deployed on Arbitrum, and we are working with a few other blockchain networks. But to your question on investors, really investors know in blockchain, everything is transparent. Even the transaction is visible. investors do know where the product has been deployed. And depending on which chain the investor is, they could, for example, if somebody is on Arbitrum, they can deploy capital on the Arbitrum product, or if somebody is on Ethereum blockchain, they could deploy capital on the Ethereum deployment of Helix. So yeah, it's transparent to the investors.
Ultimately, the input to you is a stable coin. That means what I maybe want to do as an investor as well is to lend out my assets that I have, whether it's Bitcoin or Ether or whatever. And I can, of course, lend them out and get the stable coin that I can then give to you and earn the return on the tokenized private credit. The Lego of decentralized finance at its heart, you can put this all together and create the financial system that you want to operate in.
We deal only with the stable coins, and investors may have already be having a repository of stable coins, or they may go to other markets to have stable coins and then can enjoy these sustainable yields from real world activities.
You said these two markets are pretty distinct, different pools of liquidity, of course. What I think needs to happen is that just a natural process now that the first institutions are getting on-chain. That's just a matter of time that this will slowly converge. What will be the next catalyst?
Right now, if you look at real world asset space on chain, this is somewhere not Web 2, not Web 3, Web 2.5, as many people may say, because this is when you look at complete on-chain DeFi ecosystem, the ownership and the value both are represented on-chain. Whereas when it comes to real world asset, the ownership is still represented with some sort of legal document. So there is a representation of ownership on-chain, maybe in the form of some token that represent the ownership, but the value transfer typically happens off-chain because the asset is all coming from the real world. So until the entire financial market to a significant scale really gets onto an on-chain infrastructure, there will be some frictions. And I think it's just a matter of time. I think the regulations are evolving in many jurisdictions. Many jurisdictions are really looking at it very balanced. Instead of a completely negative view, they're looking at, okay, let's see what the utilities are. They're taking a very balanced approach, which is good. Once there is clear regulatory framework and the blockchain infrastructure, again, depending on which chain you go, there are certain challenges in terms of scaling. So I think that user experience and scalability improves. That would be the time when the market starts converging. But in the meantime, the real world asset protocols of the current generation would prove certain use cases, which could maybe become the building blocks for the future innovation.
Regulation, it also includes the tax treatment, right? You're living in a good jurisdiction with Singapore, much better than we are here. But obviously that matters to people ultimately look at their net return when you're a retail investor.
When I was in Tokyo with some of the conferences and we met, I had a chance to have interactions with some folks from Tokyo Metropolitan Government. And I got the sense the government is really trying to see what can be done to really leverage on this innovation on the Web3 and on-chain. I think it's just probably a matter of time once they figure out the right strategy.
How do you see this from a regional basis? We've got Japan, we got regulation, we've got Hong Kong is coming up hot and fast. Thailand had custody rules at least out. It seems like all of Asia is moving in the right direction of, in some shape or form, facilitating these new structures. Where's the most interesting part from the business perspective for you currently? Where's the most demand for what you're doing?
When it comes to regulations, on one end of the spectrum, you have jurisdictions like Switzerland, where there are very clearly laid out digital ledger-related regulations and frameworks. And on the other end, you have the states and some of the other countries where they're still figuring out. And then in between, you have countries like Singapore, Hong Kong, which have taken a very balanced approach. If you were in Singapore FinTech Festival last year, you would have seen a lot of these different booths, which were really showcasing different practical use cases of tokenization or purpose-bound money and that sort of thing. I think whichever way, it's always good to have regulatory clarity for any industry to really groom and grow.
Are you as a company on either side also looking at the Middle East, whether it's Dubai or Saudi, seem to be getting lots more mind share as well?
We are seeing a lot of activity in UAE particularly, and we are actively studying it. But I don't have a deep understanding yet in that market, but we see that the activity level is there. There's definitely a lot of things happening, including certain free zones or regulatory bodies that have been set up, particularly for virtual assets in some of the Emirates within UAE. There's some level of activity happening. I may not have the full understanding yet of the entire depth of it.
For me, it's the outer range of what I'm looking at when I talk about Asia. Also, Dubai is the onshore zone versus the offshore zone. You really need to be on the ground in many cases. So what's next? Fast forward 1 year, second half of 25. Where do you want to be with Helix and Helicap?
We're really quite positive about the growth of private credit as an asset class because it provides uncorrelation to both public capital markets on the traditional TradFi side, as well as it provides an uncorrelated yield opportunity even for DeFi. So we see this as an asset class which will see a significant growth. If you look at DeFi markets right now, there needs to be the Web3 community is typically very pro towards short-term liquid assets because on-chain assets are always very liquid as compared to real world assets which would have longer tenors, etc. So there's a bit of education and understanding of this asset class required, which was exactly the case even in traditional side as well about a decade back. But overall, quite positive about the opportunity and the scale and growth that is ahead of us.
We started with this comparison public-private market, and now we rounded out with that as well. If you're trading treasuries or so, it's very clear what credit risk you're taking on. But then when you get into even corporate bonds, becomes already difficult, never mind mortgages also. And so it almost feels like with the excess, because it's a bilateral relationship, very close with your lender, you get much more data in the private markets these days than you actually, as an investor, a regular investor, would have in the public markets on some of these publicly traded bonds.
When I came in, one of the stark realization I had was with the public capital markets, if you need to look at any data, you just go to Bloomberg, FactSet Terminal, log in, and you can see a lot of financial reporting and a lot of access to data. Whereas private credit markets or private capital markets in general, there's not a lot of data available. There's no standardization of reporting, etc. And so we had to really do a lot of that work ourselves first in terms of getting access to the data. Initially, when we started, obviously nobody would give access to their loan tape, but they understood over the time it required some education that look at the transparency of data would enable us to unlock more capital and then bring it at an institutional scale. And now we have built a reputation such that people understand that we could bring really scalable volume of capital, but our approach is very data driven. We will look at the data, and the data is what unlocks the capital. Eventually, market understands it. 6 years ago, when we started Helicap, we didn't have access to data, but now the market has moved to a very different stage, at least in our case. But is that the same with others? I'm not sure. It depends on what kind of risk management each player is having internally.
What you have now is much more granular, much more detailed than anything you would have had on whatever corporate bonds on Bloomberg, right?
I haven't seen corporate bonds, but for the portfolios that we are interacting, we get to have quite granular access on the underlying portfolio.
Do you see any risk factors there? Is there a risk that banks are waking up and saying, oh, we'll find a way, despite the cost of capital, to do this business in some shape or form? Where would more competition come from? Just from people like you and your team? Or is that the TradFi sector that bounces back?
We definitely see a lot of institutional and traditional banking interests coming. JP Morgan was trying to build something like a private credit desk or something along those lines. That interest definitely is there from larger banks as well. In terms of risk, it really depends on private credit. There are 4 or 5 levers. You have price, you have tenor, you have seniority, you have security, and depending on how you are structuring across all those, if you're doing a long tenured deal or a long tenured loan, then obviously your pricing would be higher as compared to a short tenured loan where you're taking very less liquidity risk. Then the pricing would be adjusted accordingly. Same goes for security. If you're taking collateral, what level of collateral? If you're taking high quality and larger volume of collateral, then that would be accordingly and adjusted into the price. Similarly, seniority in your within the liabilities. Where are you in terms of seniority? Are you senior? Are you junior? That also determine what kind of pricing would have. So risk would really depend on what kind of structuring each player individually is doing on specific deals.
Thank you very much. I've got basically a full panel of Jitendra instead of the small segments when I go to a conference. Thank you for sharing.
Thanks for taking the time and inviting. Would love to talk again whenever you like.